Okay, we're going to start the session right now. Carolyn, I'm Marty Kierman, head of the Tax Credits Incentive Advisory Group, and welcome to the webinar today. Carolyn Smith-Driscoll, who's with me, is working on getting these slides popped up on the screen, which we'll get to in a moment here. And I just want to thank everybody for joining today. This is another in our monthly podcast on the employee retention credit. It seems as if there is always something to talk about when it comes to the ERC month over month due to the fact that it's a very popular incentive. It is also a very abused incentive, which we're going to talk about as well today. And so the topic today is how to avoid the scams and risks of ERC mills. We will talk about that. I'll define what an ERC mill is because it's a somewhat undefined term as well. And we'll just talk about what we've seen from an abuse standpoint with respect to how certain providers, these mills that have popped up, are talking to clients and talking them into doing the credit, or even for those that they have done the credit and they actually qualify by providing, like, we'll call it a lack of documentation. Why don't we move to the next slide and we can talk a bit, and we can show our nice pictures of ourselves here. Anyway.
Is it moving?
It is not yet. I can do the whole thing from memory if it doesn't, though, so that's okay.
My keys are not moving. Okay.
I'll just keep talking while you figure it out. It's not a
problem.
problem.
I will figure it out. Thank you.
All right. So the other thing we're going to talk about today with everybody is just a general review of, like, some of the rules around employee retention credit stuff as well. And also maybe a little bit of what's going on with respect to the IRS and how long it's taking to I guess we'll call it process claims, and also what their current stature is with respect to examining them and how vigorously they are and what some of the questions they're asking of potential, well, of certain taxpayers. So cool. Real quick, I'll just talk. Yes, we're going to talk about part of this thing always when we do this is what are the benefits of working with an accounting firm as opposed to an ERC mill. And why don't we just go to that slide a little bit and we'll talk that through, because I'll get to the definition of a mill here. When you're working with an accounting firm or someone who is actually signing your amended Form 941, I think you're going to get both, someone who has some skin in the game. They actually are opining that you qualify for the credit, as opposed to just providing you with a summary of what the credits are for you to then hand off to someone else to file. We talk about this phrase ERC mills, and I'll go into what that definition means, I think, with everybody here right now. What I've seen is, like, basically there's no pure definition, but it has been coined by the IRS. And I think really we're talking about these consultancies that maybe did something else, but then suddenly jumped into just doing ERC for the past 3.5 years. Alternatively, any company that has, like, ERC in its name, I would say probably didn't have much of a history before the employee retention credit and maybe considered a mill. Additionally, I would also focus on those companies that maybe they're a little pressury in the way that they are talking to you and overly find it very easy to convince them that you qualify for this credit. And also those that ask you to sign a disclosure that says you are certifying that you qualify so that they're off the hook. And then also those that maybe don't sign the return. Finally, I would say also to the extent they're charging a contingent fee, that might be something to look out for as well. We've run into this quite a bit as we have been examining employee retention credit calculations from the other side to see whether or not a company could take financial statement benefit for it. And sometimes we just run into some problems and due to, we'll call it a lack of documentation, potentially some over aggressive positions. So anyway, with that said,
and Marty, part of the problem with that is the companies have received their checks and many of them have already spent the money, and penalties and interest start accruing. So
they've spent the money and they've also paid some of the money they received to the ERC mill. And therefore, if it turned out or related determined that they actually didn't qualify for this, and they would have to think about maybe returning these funds, or the IRS would ask, they're actually out the fees they pay to someone else, probably with no recourse there. Okay, let's move on. Well, the other thing, okay, last point is, like, when you're working with a full CPA firm, it's not just ERC in a vacuum. You're taking a look at all the potential tax positions. There is some interplay with the R&D credit and ERC. You can't double count on that. If you have a good history with a company did for PPP, you want that to be taken into account as well. But also just, certain companies right now, there's a lot going on in the R&D world with respect to 174 capitalization.
Yeah.
ERC can be a great way to help compensate and maybe pay for some of that stuff if they actually qualify. ERC is another incentive that's available. And I lost. Oh, sorry. Anyway, my thing went black. Anyway, so I guess we have a polling question. How did you hear about this webinar? A Cherry Bekaert Tech Advisor, email from Cherry Bekaert, friend or colleague, or Cherry Bekaert alum, or a social media post. Sorry, guys, my phone went, or my screen went black and I couldn't see anything. I didn't know if you could hear me. I thought I had to dial back in.
We could still hear you. And thank you for everyone today who's participating. If you have any questions, please enter questions in the chat. And as we go through this, we'll try and address them. If we don't get to them during this webinar, we will follow up and make sure we answer all questions.
All right. Very good. They got an email from Cherry Bekaert. So again, I say thank you to everybody in our marketing team for getting the word out. Very good. Okay. So let's talk a bit about some of the rules. Let's do a quick refresher on the employee retention credit. Common parlance, file for the ERC. Well, there are actually 4 employee retention credits. There's one that was the original one, the OG, back in 2020. It covers the time period March 13th, 2020 through December 31st, 2020. It was there were then 3 more ultimately added, actually 4, and then one was pulled back. But the 2020 credit is a lesser benefit over a longer period of time. So the maximum benefit for the 2020 credit is $5,000 per employee. Essentially, what you do is during your period of eligibility, you calculate the first $10,000 of wages paid to any one employee to the extent you're a small employer, and 50% of that amount of the first $10,000 is the amount of the credit. So that works out to $5,000 potentially per employee. For each of the 3 quarters in 21, there is a separate and distinct employee retention credit of $7,000 per employee maximum, essentially 70% of the first $10,000 of wages plus healthcare expenses paid to the employees during a period of eligibility. What's most important here, and that we've been trying to get the word out as well, is that you can still apply for the employee retention credit for the 2020 year. You have less than a year though. It is April 15th, 2024 is the ending of the statute of limitations for payroll tax purposes with respect to when you can actually file for the 2020 credit. The 2021s, you have a year beyond that. It's April 15th, 2025. So there is still time to assess whether or not you qualify for the employee retention credit. And we'll get into some of the qualifying criteria right now on the next slide. Okay, so for both the 2020 and the 2021 credits, you look at what's known as a government order or a government mandate test, and also what's known as a gross receipts test. Just theoretically, the employee retention credit is intended to reward companies for keeping people employed while the government was putting brakes on the economy. So if the government was essentially slowing the economy down through these COVID-19 safety orders that limit like commerce and travel and group meetings, the thought was that's either going to have a slowdown on you as a company directly or upon your customer base. And so the way that you measure the declines, basically the stoppage to your customer base, is through what's known as the gross receipts test. So to the extent in 2020, in any of the quarters of 2020 compared to the exact same quarters of 2019, you were suffering more than 50% decline in gross receipts. And that is all gross receipts, sales, dividends, interest, rents, royalties. You would then automatically qualify for that quarter and potentially the next one as well. At the same time, and companies also can qualify if they had a direct impact by some of these government orders, meaning that the government orders were applied to them directly. A COVID-19 order caused something like work from home that actually caused a partial suspension of the business. Also potentially, a lot of companies are essential businesses or were during the time of COVID, to the extent the IRS put out a position in one of its notices and some of the original FAQs that if a company had suppliers who had a COVID-19 order causing a partial suspension to the supplier that caused another sort of down the chain partial suspension to the actual employer itself, then they could potentially qualify that way. That's known as a supply chain disruption argument, which the IRS put out there. And then recently they've provided some guidance as to how that should be interpreted. And that is one of the areas that has been most abused, I think, when it comes to some of the ERC mills espousing a position that sort of supply chains were just out there. Anyway, point being, you can qualify due to a government order limiting commerce traveler group meetings, applying directly to the company and causing a partial suspension, or measuring on your customer base a gross receipts decline of more than 50%. In 2020, we found the government mandate test to be the more common way of qualifying due to the fact that a 50% decline in gross receipts is quite a bit. And so you saw that quite a bit in the restaurant industry, hospitality industry, not too much beyond that. But let's move to the next slide and talk about 21. All right, in 2021, the rules are substantially similar, but actually easier for the purpose of qualification. Instead of a more than 50% decline, a taxpayer only needs to show a more than 20% decline in any of the first 3 quarters of 21 compared to the first 3 quarters of 19, respectively. What I have found is that more companies who legitimately qualify under the gross receipts test for 21 than under the government order test, due to the fact that some of the government orders stopped to be as partial suspension causing, as limiting as they might have been out there, but the company may have adapted at that point, and it really wouldn't have a partial suspension. So there is a facts and circumstances analysis that you have to analyze with respect to every company to see whether or not the particular COVID-19 orders actually caused a partial suspension on the business. But from a gross receipts perspective, as I mentioned, it's easier to qualify. You only need to show more than 20% decline compared to that same quarter in 19. And that was very common. What we have also seen, though, is as companies, and not just companies, let's say churches, let's say schools, nonprofits, have had the chance to think back and focus on how their organizations suffered partial suspensions due to some of these COVID-19 orders. We have made the case that certain extracurricular activities at schools couldn't be provided, which caused a partial suspension. In the nonprofit area, certain fundraisers and events could not be held, which caused a partial suspension on what's known as a more nominal portion of the organization. Point being, again, it's much easier to qualify under the gross receipts test, but I think it takes a good analysis of what the organization does on a day-to-day basis, or was supposed to have been doing, at least comparing back to what it was doing in 2019, and see how these COVID-19 orders had a direct impact on the business, on either directly or upon its suppliers, which we'll talk a bit about more.
Marty, can you unpack what a government order is and what it is not?
Sure.
I'm thinking CDC, OSHA. Talk a little bit more about that.
So the two you mentioned are not, right? And so I'll unpack it this way. A government order, and this is why we call it the government mandate test or the government order test. It is a COVID-19 specific order limiting commerce, travel, or group meetings. It is COVID-19 specific. It is not a piece of CDC guidance or OSHA guidance that existed pre-COVID or it exists today. We have seen a number of ERC mills cite just general CDC guidance, guidelines, OSHA guidance as well as qualifying, and therefore they've just qualified every taxpayer for every potential quarter that under which the ERC operates, and maybe some beyond that too. What a government order really is, think about it is state or local order. Think of a work from home stoppage. Think of a capacity limitation, some of the social distancing rules as well. But I will say this, don't just think about the US orders. We have gotten comfortable with the position that a foreign government order, to the extent it is limiting commerce, travel, or group meetings and COVID-19 specific and having an effect on the business, can be cited for purposes of the employee retention credit. You won't necessarily find that specifically discussed in any of the guidance. We have had some discussions with the IRS about it, and they have seemed to be in agreement with that position. I certainly haven't seen any guidance saying no either. So when we talk about some of the supply chain disruption stuff, you'll see that many of the foreign orders are on some of the foreign ports and also potentially on some of the maquiladoras and some of the locations in Mexico as well, where companies receive some supplies. So we take a pretty broad approach in looking for legitimate government orders. We also, it should also be known that the duration of eligibility only lasts as long as the government order is in place. As soon as it's off, the period of eligibility ends, even though there's, there may be disruptions that take place well beyond the time period that the government order was in place. But again, the US government is only paying you for time that some government is putting a stoppage on the economy. They can't really control how long it lasts after that. All right. And then I guess one other thing, and it means that's fine, stay on the slide, is that they opened up the employee retention credit in 2021 to certain government affiliated hospitals and public universities as well. And it was also just confirmed in some guidance 2 weeks ago that a federal credit union qualifies as a potential eligible employer. And so that's for the 2021 credit only. That's where some additional, we'll call it liberalization of the rules took place too. Okay. The partial suspension of a more than nominal portion of the business. This is an area that's ripe for abuse too. When you cite a government order causing a partial suspension, it has to actually have an effect on a more than nominal portion of your business. It can't just be a supply chain disruption on one small supply that you receive while you offer a multitude of products. You have to show that it's actually causing some kind of partial suspension on your business. And the way that's generally measured is to show that it's having an effect on a portion of your business that makes up at least 10% of the overall revenues of the business as measured in 2019, or the hours associated with providing that particular business offering in 2019. Again, the common and easy way to think about this is, my colleague Deb Walker always uses this, is think about the grocery store that has to shut down its salad bar. All right, it's still offering all the groceries. The salad bar is like a very, very small piece of what that business is. But think about the salad bar restaurant that gets shut down. That's the whole business there. So you want to have the government order affecting a more than nominal portion. And more than nominal is not that much. It really is just showing that more than 10% of the business right there. Okay, let's move on. Okay, gross receipts. The most important thing here to keep in mind as we're talking about what it means to measure a substantial reduction in your gross receipts is that it's not just your sales from your P&L. It also includes dividends, interest, rents, royalties, and some of the other income items. Pretty much what you would see right on the front of your tax return from like line 1C through the other income. The only difference when we're thinking about tax exempts as opposed to taxable entities would be that for sales of assets in the taxable entity arena, it's the sales price less the basis, whereas in the tax exempt area for the 501c3s, it is the total gross proceeds. And I have found this rule to be somewhat helpful to some of the nonprofits and churches and schools out there, to the extent they have an endowment or they have some assets or that they hold. Say they sold something in 2019 that was like a large holding, and it was totally unrelated to COVID. If there was not a similar sale in the same quarter in, let's say, 2021 or 2020, there can be sort of a higher like gross receipts number in 2019 as a result of that. So it's important that you look beyond just what the sales are and look clearly at what dividends, interest, rents, royalties, sales of assets are as well. All right.
And then something that we just encountered yesterday, well, PPP and ERC, you cannot utilize the same wages. So you need to carve that out. But we were asked about state grants and if they affected either the elimination of wages because the state issued the grant, or if they affected gross receipts. And the answer is, if it's not specifically called out, no, you want to look into it. So shuttered venue grants, restaurant revitalization grants, those are not considered part of your gross receipts. You don't have to include them.
And that's important. And that was clarified in August of 21 by the IRS, along with the clarification that PPP forgiveness is also not a gross receipt as well. They didn't penalize companies for getting a PPP loan. All right, polling question. Yeah, it's fine. Do you think you may be eligible to claim the employee retention credit, but have not yet filed for it? yes, no, or I don't know. I'm going to get back to talk about what I was talking about though for a minute. It's important. We ask every company with which we work about what they received in PPP and what their overall covered period was. Originally, when ERC came out, if you got a PPP loan, you were not allowed to claim the employee retention credit. That then later changed at the end of 2020, which made every company go back in time and take a look in 2020. And then it really opened it up to every company that got PPP in 20 or 21 to also claim employee retention credit on top of that. And I think some of the reason that companies didn't focus on ERC is because they were so tied up doing PPP at the time. That's a good, legitimate reason, understanding why it wasn't. And then also some companies really didn't understand the effect that these government orders had on their business. They really couldn't measure it until they looked back in time to see exactly how they compared in that particular quarter compared to 2020 or compared to 2019. All right, polling question 2. Maybe able to no. So 58% no. 10% yes. All right. So I think that means that a lot of people have been getting the message on the employee retention credit. They've seen Phil Dunphy out there talking to you from Modern Family every night on his commercials. You may be eligible for it. I like Phil. I think he's giving good advice, but we're here to supplement it. All right. This is what Claire would warn about to Phil. Fraud in the system. So let's talk about this here and let's move on. I think we've talked about some of this, but let's go through it methodically. If you're approached by an ERC mill, a consultancy, to do a project, or you're being harassed on the phone, actually, that's one of the warning signs. If you keep getting robocalls about the employee retention credit, that's one of them. But again, if somebody's telling you that OSHA or CDC guidelines are enough to get you qualified, definitely don't do that. I would also say if they're not signing the return, the file return, I do it with somebody else. Have a your CPA, accounting firm, whoever, take a look at that. If your revenues just increased so significantly in 20 and 21 compared to 2019, and you're trying to make the argument that you have a partial shutdown, you're really going to need to have a lot of facts there to justify that. And sometimes maybe you can, but it's pretty rare. And so also just be wary of them telling you, like, it doesn't matter what your gross receipts are. Technically, maybe that's correct, but I do believe that the IRS is going to be looking at how well a business did compared to 2019. Again, also, if they're asking you to attest that you qualify, and then they're going to take that attestation and then just do a calculation for you, again, they may have not been giving you half advice, poor advice, whatever. And I do find that that's tough sometimes for some taxpayers because they've been listening to this consultant, and it's somewhat unfair because they're supposed to be experts. But then the consultant doesn't have any skin in the game. They don't sign the return. The company is left after they paid them a fee, and then they have to get somebody to file this for them. It's tough. So just keep a lookout for anybody that's pushing it too hard upon you. You have time to still consider this thing. And so let's move on.
Another thing that I would say is if the ERC mill, or I'm sorry, there's noise, is talking about Amazon guidance or specific industry guidance, again, it must be from a governmental order. So
that is so important. Yeah, we've been hired to review a number of claims for others that are assessing their validity, and we've seen that position where a company provided some overall guidance, and at that point that wasn't enough for us to make the claim. All right, Carolyn, you're new there. If you can still move to the next slide, but if not, I can keep.
Sorry, no, I will do it. My computer was going to die, but there we go. Sorry.
Very good. Excellent. Okay. So we're going to talk about a couple things. On May 15th, 2023, this happens every year. The IRS comes out with their Dirty Dozen top 12, 12 is in a dozen, top 12 tax scams that are out there. And ERC is absolutely number one. And they provide this warning sign is like, look for unsolicited calls. Look for the statements that the promoter, can determine ERC eligibility within minutes. We'll just figure it out for you. It generally takes a little bit longer. You need to take some time, provide some financial data. Also look at these large upfront fees that before you even get involved with a scoping. And I think personally, when you're dealing with anybody that's taking a contingent fee, they're sort of automatically incentivized to get that credit as high as possible because that generates what their fee is. I just think there's a conflict of interest there sometimes. So try to avoid that too. Oh, and then, yeah, if anybody's like, claim the ERC because you have nothing to lose, you may have something to lose, which would be a fraudulent claim. So the most important thing is that you work with your CPA. And also those who are telling you to ignore the advice of the trusted tax professional. But here's another one I just remembered. Those that tell you that the IRS guidance doesn't matter, that it's not controlling, that you shouldn't follow it. Technically, it's not a regulation. It's not a law. It is IRS guidance, but it is the IRS who's going to be looking at this. And I think if all your positions are completely contrary to what the IRS has provided in its guidance, and you don't necessarily find a lot in the statute that is like pro your position, just take a moment to take a look at that, or at least have a second opinion, or give us a chance to do a second opinion for it, so we can warn you off or tell you, fine, go for it. It makes sense. Our goal here is to advise clients to take advantage of it to the extent they qualify for it, but not definitely warn them against some of the promoters or ERC mills out there. So it's interesting that the #1 tax scam for the year 2023 is the employee retention credit. Again, that's not to say that it is not a legitimate credit. We still work with companies that qualify. It's just that it's gotten so much press that everybody wants to know about it. And I think the reason for that is everybody's being told that they do qualify for it. But I think some of this dirty dozen stuff and some of the other things we've seen from the IRS are causing people to think a little bit more about it and actually causing them to get second opinions. All right. Okay, this is for the tax practitioner. The IRS Office of Professional Responsibility. One thing to keep in mind when you are approached by somebody about the employee retention, or they tell you, well, it's free money. It really isn't. You actually take these refunds into income back. It's basically, if you got a 2020 an employee retention credit specific to the year 2020, you actually have to, when you receive it or before, after you make the claim, reduce your wage deductions in 2020 by the amount of the employee retention credit, which means effectively you're taking it into income back in that year, 2020. You do the same thing for 2021. So it's not free. But at the same time, if your tax professional that's doing your income tax return is not confident in the employee retention credit that you have claimed or its veracity, they theoretically, according to OPR here, should not file that return with the reduction in deductions, even though it's giving money to the Treasury. They're treated potentially as perpetuating the fraud. It's just a note for tax professionals to be concerned, skeptical, or at least testing of whether or not the retention credit claim has validity, and we'll call it more likely than not to be sustained from an income tax perspective. All right, so dirty dozen, Office of Professional Responsibility, and then the House Ways and Means Committee in July held a hearing. I know Carol and I both watched it. It was pretty interesting. It was about 2 hours long. And the whole purpose of it was to talk to practitioners, a representative from a PEO, and also another representative from overall, like representing a bunch of nonprofits, just to hear their testimony on what was driving some of the fraud, what was driving some of the success, and what could be done to enhance or, I would say make better the process. One of the things they discussed was, and everyone should know this, is that on a retroactive basis, you cannot do an electronic filing for the employee retention credit. You actually have to do a paper filing. And so that's one of the reasons that we've seen so much backed up in the system, is because it couldn't be filed electronically. So we may see something next year with some ability to file these, at least in the last year of the 2020, and maybe one more year to go with 2021's, some ability to electronically file for the employee retention credit. But that caused a big backlog of fees. The other backlog, though, is due to, we'll call it, all the fraud in the system. There are so many claims still coming in to the IRS. It's hard for them to sift through the good ones versus the bad ones. And so what should be known is that oftentimes the IRS is just going to issue the refund. And then you're still potentially open up, from a statute of limitations perspective, to have them have the ability to go back and take a look at what you got and potentially ask for the money back. So I would say, if for anybody who has any amount of, I don't know, skepticism about whether or not they're actually entitled to these funds, don't cash the check or keep the money in an account.
A
While
high yield interest account.
yeah, while you vet it out with potentially a CPA or other professional. It should be known that the cash you receive on the employee retention comes with interest dating back to the original quarter when it should have been filed. So it comes with an interest payment. But if you end up owing cash back, you also owe interest back to the IRS as well. So it's just important to, if you have any doubts about whether or not you actually qualify, just to hang on to that cash until you vet it out. I don't know, Carolyn, if you have anything else to talk about from that hearing, but I'm happy to keep talking.
No, I think you hit it. What I found fascinating was the lack of guidance by the IRS, all the representatives and the professionals, was the catalyst for sort of, the creation of all this creation and propagation of the fraud. So it's interesting. And I did, you mentioned that you have to paper file. There is a discussion, not now, but that you could, they're looking to have ERC claims filed electronically. So
yeah, they got a lot of money in the Inflation Reduction Act to do some enhancements, and I think that's one of the things they're going to focus on as well. The last part here is like there was clarification around what it means to receive an overpayment of an employee retention credit, which really means like an employee retention credit refund to which you aren't entitled. It's treated essentially now and clarified by Treasury that it's treated as an underpayment of tax. So the same rules apply to underpayments of tax as do overpayments of ERC to the taxpayer. And so also, if you use a PEO, to the extent the PEO is actually doing the filing for you, they may be liable and you may be liable for the underpayment of tax as well. I have found the most frustration from organizations that work with PEOs, and not because PEOs are inherently frustrated, they're actually wonderful organizations. It's just that they don't have a direct line to the IRS. They have to use the intermediary of the PEO to do the filing for them. And the PEOs are filing not just for them, but for many of their clients in a batch filing. And that's why we heard during that Ways and Means Committee testimony that the filings that are most held up are those done by the PEOs, because the IRS has to assess the veracity of the claims for multitudes of organizations that the PEO represents on one filing for one particular quarter, but like with just multiple taxpayers there. So that has caused a backlog. And I would say just, I've seen frustration from clients that work with PEOs. I've seen frustration from the PEOs as well with the IRS in terms of getting that stuff refunded. And the PEOs are of the opinion that, they actually work with these companies and should be a little more trusted to make some of these analyses. But again, it's all over the place with respect to how the IRS is analyzing these claims. There are more people working on them now. They used to take anywhere between 6 and 12 months. I think it's maybe between 6 and 9 months now to get the refunds. I've seen some come in 4 months, which is great. I've also, if everybody read the Wall Street Journal last week, they said the IRS is going to start slowing down the way they do some of these refunds right now because of all this discussion around some of the fraud. So I think it's to be tested in terms of how quickly the refunds will be coming. I've only seen them speed up lately, but we shall see as we see what happens in the system and stress on the system for the next year. All right. Okay. Supply chain disruptions. We can spend some time here. All right. So I get frustrated at the employee retention credit mills that tell their companies with whom they're working that, hey, don't worry about the IRS guidance. We have a better position because the IRS guidance shouldn't matter whatsoever. But we also want to give you an ERC filing based on the fact that there was a supply chain disruption. Now, the supply chain disruption analysis was only ever espoused in the IRS guidance. It's nowhere in the statute. So what they're doing is like saying the IRS guidance doesn't matter, but for this position, we really like the IRS guidance. So they're trying to have it both ways. Anyway, the point here again is, and the theory being that if a company that's an essential business or a non-essential business doesn't have a more than 50% or 20% decline on their gross receipts, or doesn't have a direct impact or partial shutdown due to government orders on them. The government orders imposed upon the supplier that is supplying them with some kind of good or service, I suppose, that through a transitive property, the partial suspension on the supplier then applies to the organization itself. The IRS provided 5 examples of, and this was actually welcome guidance, not for purposes of necessarily promoting the supply chain disruption perspective, but rather to talk some people off the ledge from making some claims that they shouldn't have. That like, and if they're just supply disruptions and the penumbra of the economy, we kind of know it, reading some articles about it, that's really not enough. What these rules, and we'll go through them, and what this guidance tells me is that 1, you need to know who the supplier is and where they're located. 2, you need to know what the government order is on the supplier. 3, you need to show that you couldn't get the supplies from somewhere else. 4, you need to show that you didn't have enough of the supplies on hand from a surplus perspective, that the supply chain disruption didn't really matter to you whatsoever. And 5, you only get the ERC eligibility for the duration of the government order on the supplier. Those are the 5 rules that go through these 5 examples. So as we see, and we don't need to maybe go through all of them, but you can read them, and we can provide this slide deck. And if you look at the supply chain disruption analyses, the first one we have here, they had a surplus of goods, right? Supplier vaguely confirmed that there was a delay due to COVID-19, but did not provide a government order. All right, 2 problems there, right? 1, they had a surplus, so who cares if there's a supply chain disruption? They have enough stuff on hand. 2, there was like a vague confirmation that COVID-19 applied, but they didn't cite what the order was. So 1, you don't have a partial suspension, and 2, you don't have a partial suspension because you had the overall surplus of goods. So that's example 1. Why don't we move to the next one? Example 2, again, we have supplies stuck at port. It was, again, assumed. These are really easy examples for a client to fail, right? But they're giving you exactly what we've seen. Like, news sources stated that COVID-19 was a reason. The supplier mentioned critical goods were further delayed due to a truck driver shortage caused by COVID-19, but they couldn't identify specific government orders. And well, that's really it. You just couldn't identify what the government orders were here. So that's the main thing as well. You had to identify the order and its duration upon the supplier, and then show a causal connection to your business as well. Let's go through them all, because they're all kind of the same, but a little bit different.
Yeah.
Right. So, and this will just get the point across. Example 3, you find that employer and supplier was suspended by government orders for April 2020. And then the remainder of 21, they experienced delay in receiving critical goods. This here issue is about, you only get it for the duration of the actual government order. There's a residual delay, doesn't matter. You only get it for the duration of the government order. Okay, let's go to next. And again, OSHA and CDC guidance is not a government order that's going to apply for this time, unless a state actually adopts for COVID-19 purposes specific enforcement of the OSHA guidance. Then you may have an opportunity to use that guidance adopted by the state or local authority in the government order. So that's one particular area where we've seen the ability to use some of the OSHA guidance. Okay, so here we got employer could not obtain goods. They were able to obtain them from an alternate supplier at a higher cost. And then I've seen this. They go, yeah, but I paid so much more to get this, but it's still not a supply chain disruption. There's nothing about additional costs in the employee retention credit. So again, when you have these providers saying that this supply chain thing is enough, it really can be, but it really has to be well documented and specifically tailored to the duration of the actual disruption. Let's go to example 5. And then, thank you, by the way, Carolyn, for moving my slides. All right, this one's great. You have an employer with a large retail business selling a wide variety of products. And basically what this thing says is, like, there's a supply chain on one of them, right? Or 2 of them. But it really didn't affect overall what they did. While a limited number of products were not available, the employer would still offer a wide variety of products to his customers. Again, it's not a disruption to a more than nominal portion of the business. So I hope going through this actually clarifies for anybody who, I don't know, got a supply chain disruption check or was thinking about it. So let's go to polling question 3. All right, which of these may be a warning sign for risk in ERC claims? All right, 1, fees based on percentage of credit claimed. 2, total reliance on employer to determine if qualified for ERC. 3, 2-minute application process. 4, OSHA guidance. Or next, any of the above. All right, I'm just going to tell you the answer is all of them, but this is just a test whether you guys are still watching for CPE purposes. But it's really any of those things. I think, again, just because you worked with a consultant, it doesn't mean you don't qualify. But one of the things that we have found is that a lot of companies, they're worried about the IRS and what may happen, or they have to explain why they have to cash this check to their board before they do. And so we've been called into, I don't know, I won't say double document because they didn't document it the first time, but actually provide documentation around the fact as to why they may qualify. Basically get that opinion from us as to whether or not there is a qualification. Cool. Anybody picked any of the above is great. 85%. I wonder who the 3, 4, 3, and 5% people were doing, but definitely getting their CPE anyway. So that's good. All right. IRS exams. This is important. And this slide has been in our deck for a while, but the most important thing I would say when we work with clients is what we'll call an audit-ready deliverable. What that really means is that it's not necessarily something you just hand over the service, but it does contain all the information that you could respond to an information document request from the IRS. And so what do you want in there? I mean, obviously, you want the original Forms 941. You're going to want to have all the original payroll records for each of the individuals. You want to also, and that's the W-2 stuff as well. You're also going to want to have a measuring, if it's a gross receipts client, of what those gross receipts were in 2019 that are actually following the rules of how gross receipts should be calculated compared to what they are in 20 or 21. Additionally, if you are filing under a government order provision, what are the orders? Have links to those orders and the duration of those orders. And then most importantly, again, it's tying the orders to the company's operations, indicating how they were affected, showing some kind of, I don't know, if it's a supply chain thing, lead time disruption or lead time delays, and also why those particular goods being provided were made up a more than nominal portion of the business. There's data, there are facts, there are laws, and those all need to be tied together to tell the story of a partial disruption in a way that is reasonable and that you can more likely than not conclude that you're an eligible employer for purposes of this credit. Anybody
and you want your provider to document, what happened 2 years ago. You want that package because the statute is 3 years for 2020, where the IRS can come back and audit you, and 3 years for quarter 1, quarter 2 of 2021. And it was increased to 5 years for quarter 3 of 2021. I will say that if there is any indicia of fraud, there is no statute of limitations. So even if there is no fraud and you're fully entitled to your claim, in 5 years, it will be very challenging to go back and obtain all the information that Marty was talking about. So please ask your provider for all of this information. It is critical.
The other area that I've seen where there's still opportunity for companies to claim these credits that they hadn't thought about is when they've done an acquisition of a company, and that company hadn't claimed. To the extent you did a stock acquisition, generally speaking, and that EIN survives and you still own it, you should be able to go back and do a claim. If you did an asset acquisition, it's pretty much game over. It goes with the seller of the business. Some of the work we do goes around who actually gets to claim the employee retention credit. Some of the work also goes to how do you calculate the overall control group? Because when you do this qualification, you look to not just the company, but if, say, the owner owned 2 businesses, you have to look at both together. Also, finally, another area is those companies that are owned by private equity. To the extent they are, the fund from a private equity perspective is generally not treated as an active trade or business, but rather a passive investment vehicle. And as a result, it kind of breaks aggregation among all the different portfolio companies that it owns. It's much more complex than that, but that is a high level summary of how that works, why companies, why private equity funds can actually claim employee retention credits on their portfolios. Why don't we go to the next slide, which is just a continuation of some of this IDR information. And some of the stuff we've already talked about, but most importantly is showing that there's no double counting on wages that were funded by PPP that went into the employee retention credit. Also, similarly, as you're thinking about the 2021 credits, if you did a research R&D credit claim and you want to claim a 2021 employee retention credit, you can't double count on those wages, but we have found that like you should put put those wages into the employee retention credit as opposed to R&D in that year, due to the fact that there's a much higher statutory credit available for ERC than R&D, but you still need to track your R&D attributes for purposes of the base amount for later years. Since you're doing an amended claim anyway back to that year 2021, you can make the adjustment to R&D and ERC at the same time. But just another thing to keep in mind, why it's better to work with an overall CPA firm than just a consultant. All right, let's go to the next. This is cool. This is how we approach clients and what happens. So when we talk to anybody about the employee retention credit, sometimes it's factual, sometimes some of this stuff we'll go through, but really, what do you need from baseline data? We need the prior 941s that were filed. We want to get the org chart so we understand exactly what the control group looks like. We want to know if there were acquisitions or dispositions. Also, most importantly, we want to get the number of full-time employees. And we didn't go into this too much because we skipped over some of the stuff, the basics, but the credit itself is maximized for companies that are fewer than 100 full-time employees for the 2021 credit, or fewer than 500 full-time employees for the 2021 credit. Again, 100 for 2020 credit, 500 for 2021 credits, and that's measured on average in 2019. We're always doing our measures in 2019. So if you're a small employer and you qualify, you can put the wages associated with everybody that's an employee into the credit calculation. If, however, you're a large employer, you can only make a credit calc for those employees who are paid not to work. And this is another area where I have seen fraud go rampant. Some of the consultancies are claiming that any of the PTO or vacation time claimed by these employees for, I don't know, their trip to Maui or whatever that year, that's treated as time not worked. Clearly, the IRS guidance says that that does not count, that PTO should not be included in there. What you can, though, for large companies that couldn't take advantage of the FFCRA, the COVID sick leave pay credit, to the extent they had a separate COVID sick leave tracker that calculated time and payments associated with COVID sick leave pay, and they didn't claim a credit for the FFCRA, that would technically be time not worked, in my opinion, when you look at companies that are large. So that might be an area to think about for large companies that are still subject, that were eligible in the first place due to either a gross receipts decline or a government order causing a partial shutdown. But anybody that's telling you that you can just stick all the vacation time in there as a large employer, if you're just a really big company, please just don't do it, because I think that's going to be the first area that the IRS goes after. And then last point, government mandates. When we're working with companies, we know where these government mandates are in their duration. That's not on the company to necessarily find out, although if they did get some kind of communication from the state or the governor's office or something like that, we'd be happy to look at that too. And then finally, we look at the PPP data as well. All right, next one. All right, and the W-2 data, right? This is absolutely the most important stuff, right? You have to get the employee, the name. Job title may be not important, but if you're looking to find employees who were paid not to work as a large employer, that can be important for at least identifying a group or type of employee who may have been paid not to work. And again, it's the wages, gross wages, plus also the health care costs as well. So that's something else that will require. And again, this is what the IRS asks for, the baseline payroll journals, as I'll call them. Okay. We are about 10 minutes to go. Last point, and then maybe not even that much, because we can close up in a second. ERC and PPP documentation. As mentioned, you can't claim an employee retention credit for the amount of wages funded by PPP. But when we look at the PPP forgiveness, we can see that the covered period for PPP is up to 24 weeks, which can be significantly longer than the overall period of eligibility for ERC, or may not exactly overlap. There's some fungibility with respect to the wages in that 24-week cover period to which you can allocate for PPP, such that you can maximize both PPP and ERC, which is permissible and exactly what the government wanted. But it's most important that we show that you're not double counting. That's one of the first questions the IRS in its IDRs. Okay, last one. If there is a last one, maybe we can give some final thoughts. All right. So would you like to learn more about how we can help moving forward? Yes, no, or maybe in the future. Please fill that out so you can get your CPE. But before I talk and finish up, Carolyn, I don't know if you want to talk about anything. We've been reading about some of the fraud out there, some of the indictments or stuff like that, but up to you. Otherwise, I can go into.
I'd love to.
Yeah.
We've been talking about fraud and these ERC mills. Well, the IRS is increasing enforcement. They're cracking down. Most recently, a provider out of Teaneck, New Jersey, filed 1,387 false claims. He false Form 941s totaling over $124 million on behalf of himself, on behalf of clients. I mean, in reading the article, he was talking about free money. You're eligible if you have a business. And, the problem is, he's being indicted, but all of these poor people that were handed checks, because they would write down, I don't have any employees. And suddenly, on the Form 941, there'd be 30 or 40 employees. So yes, he's being prosecuted, rightly so. But the impact is really to his clients. Similarly, on the other coast, in California, there was a gentleman who filed 17 different false claims that totaled about $64 million. And the federal prison, for each false claim, that's 5 years per claim. So this is real. Again, they're perpetrating the fraud, but please be cognizant of, and don't make yourself a victim of this fraud. So.
All right. And I think those are good final thoughts. So basically, we're giving you the tools to not make yourself a victim of it. Also, just giving you some CPE credit at the same time.
It's a gift.
The gift of one. All right. I think with that said, I don't know if we got an answer to this, but I'm Martin Karaman. Also, Carolyn Smith Driscoll was with me. Our names and our contact information is here. We would be more than happy to take a direct email from you if you have any questions. We're pretty responsive. I'm pretty lonely. I like to respond to people. I got nothing else to do. So I really do appreciate everybody coming in today and being part of this monthly thing that we're doing on employee retention credits. And I hope those that come never have to come back and listen to me again one more time and that we've taught them everything they need to know. But if you do have any questions, again, please reach out. Thanks everybody so much, and congrats on getting some CPE today.
Thank you.